Good to see you. Thanks so much for joining us. My first question is whether this recent bout of volatility has led to a kind of clear change in sentiment from your clients. Are you getting a lot of calls?
Not necessarily, no. I mean, we can see that there has been a deterioration in the overall sentiment if we look at things like the AAII bull bear indicator. And we have seen a big uptick in bearish readings. But we think as far as investors, retail investors go, we should really see about what they are actually doing and not just what they're saying. So what we're seeing is that equity allocations still remain near all-time highs despite some of the wobbles that we have, and cash allocations still remain near all-time lows. Now, one really interesting thing is that we are seeing more spikes in puts buying, and so this indicates that people may not be scared enough to really sell positions, but they are willing to take some downside risk protection, and that's why they're buying puts. But we're really not seeing capitulation and selling of people saying, this is too risky, get me out of it.
In terms of positioning within the U.S. Equity space, Cameron, a lot of people seem to be saying the place to be now is the less high-priced stocks and the cyclical stocks. But has that become too much of a consensus already?
I don't think so, because if you look at flows data, what you can see is that through the summer growth scare, we actually had extreme outflows of cyclical assets. So positioning is still very light. Things like higher yields really help cyclicals as well. And seasonality is typically supportive of cyclicals, given the fact that we're now in that sweet spot of October to April. The last thing that we would look at is the fact that economic surprises, which is just economic data coming in below expectations, have gone negative. And so when those economic surprises are so low, it's typically a good contrarian buy indicator for cyclicals. But the one caveat is that we really haven't seen big downgrades to earnings estimates, despite the fact that economic surprises have gone negative. So I think what you're getting at is that there's still a really high bar for earnings going into the third quarter, which is why we think we're seeing such big downward moves to negative earnings updates from things like Nike or FedEx or Bed Bath & Beyond today and the whole retail complex. So that does get you to the point that if you are going to play in cyclicals, you have to be highly, highly selective.